Hi, it's Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's midday, Thursday, June 4th, 2015, and the title of this week's audio blog is Everyone's All In But Whirlybird Janet. Now, it's with a heavy heart that I start this week's audio blog, as one of my best friends in the world had a terrible accident earlier this week. And as terrible as it is to fight the evil forces of willful market manipulation and economic destruction, such misery pales in comparison to the feeling of pain when those close to you are sick, injured, or in otherwise trying circumstances. I hope and pray his extremely difficult surgery goes well tomorrow, and that you too give a thought to one of the best people I know, who it turns out happens to be a staunch believer in real money. That said, I have much to get through during what continues to have the potential, per the title of last week's audio blog, to be a week of infamy. Essentially, all the key events occur tomorrow, that is Friday, so you can bet I'll be writing this weekend of not only tomorrow's likely doubly seasonally adjusted NFP employment report, but the simultaneous Greek payment deadline, of which, as I write, they have neither the funds nor a willing lender, and of course, the potentially market-killing OPEC decision, which frankly appears to be a no-brainer, and that OPEC has absolutely zero incentive to lower production from a political, social, or economic standpoint. On to the day's horrible news, or as I put it in yesterday's article, Satan's laundry list. I could start in perhaps a dozen different places, such as, for instance, the potentially cataclysmic Greek and OPEC decisions tomorrow. However, to a man, the choice for best way to demonstrate reality, particularly to the 99% listening, is a discussion of perhaps the most despicable article ever written by the mainstream media. In this case, validating why I stopped reading the Wall Street Journal 16 years ago, and why alarmingly the supposed nightmare depicted in Atlas Shrugged is rapidly overtaking the real world we live in. To wit, the journal's John Hilsenrath, who at times I doubt is actually a real person, has been for some time known as the Fed's mouthpiece in the print media, i.e. the same role CNBC's Steve Leisman plays on television, given his penchant for releasing lengthy articles analyzing Fed actions within seconds of major FOMC releases. And invariably, whatever he writes is precisely what the Fed wants you to think, like, for instance, spending the past 2 years spinning any and all Fed actions as precursors to the inevitable policy tightening they so desperately want to execute, no matter how impossible a task it would be. Anyhow, in what he claims to be tongue-in-cheek humor, Hilsenrath wrote a despicably offensive article Tuesday titled "A Letter to Stingy American Consumers," in which he asked why they won't spend more money given the cold winter has passed, as well as the financial crisis he claims to have been a long time ago. Not to mention passive-aggressively mocking the so-called 99% in stating you shouldn't have taken out that large second mortgage during the housing boom to fix up your kitchen with granite countertops. For someone in my position, i.e. a 26-year financial market veteran, who not only has spent 13 of those years commentating on how Hilsenrath's masters have destroyed the world, not to mention my personal net worth, credibility, and sanity, I couldn't have been more offended. Frankly, as I write, I can feel tears welling up, encompassing what seems like a lifetime of misery, anger, and pain. And yet, I've been fortunate enough to save enough and protect what I have, like a mother does her child, to be in a better position than the average 99%er, albeit modestly so. However, for said average 99%er, who is not just struggling to save, but put food on an increasingly expensive table, care of Fed money printing, of course, such anger is multiplied manyfold, which is why this publicity stunt, or whatever harebrained reason for insulting so many so needlessly, miserably failed, in not only putting faces on the Joe the plumbers suffering from government policy, but giving them a forum to vent their rage. To that end, my good friend Mike Krieger of LibertyBlitzkrieg.com did a fantastic follow-up titled "Revolution is Coming," in which he simply listed, in his words, the top 20 responses to John Hilsenrath's idiotic WSJ article. These homegrown rebuttals are so powerful, the establishment, and certainly presidential hopefuls, if they could take their hands from the corporate lobby's deep pockets for a second, should pay attention to, which of course they can't. Essentially, they depict the real state of the economy, as we at the Miles Franklin blog have been writing of for years. Basically, anyone that wasn't destroyed by the Fed-created internet crash in 2000 was finished off in 2008. And now that the majority of America's high-paying jobs have permanently left for points east, in large part due to the aforementioned corporate lobby's control of Congress, the prospect of paying off the immense debts incurred since the economy peaked 15 years ago are bleaker than ever. Moreover, care of the Fed's maniacal ZERP, QE, and other 1% supporting policies, wealth disparity, not just here but everywhere, has regressed to that of the Dark Ages, when kings, warlords, and royalty ruled the serfs. And sadly, the experience of said 99% is not a fairy tale, but a real-life story of societal stress, both financial and mental, that is compounding each day, with each dollar, euro, yen, and yuan printed. Overwhelmingly, responders complained of what we have noted for some time, which is that the only people benefiting from zero interest rates are the immoral, sociopathic bankers that destroyed America, with the Fed's murderous help, of course. For the rest of us, the only zero interest rate we receive are in our bank accounts, held at the very insolvent institutions that require the Fed's free money just to keep the doors open, which not only erodes the value of the remaining scrip we still hold, but will unquestionably be confiscated, if not by hyperinflation, then by the bail-ins that are certain to occur when the public will for new bailout funds is not available, which I assure you it won't be when the big one inevitably hits America, and the world like a Category 5 hurricane. As for what we can borrow at, I last month noted that the average credit card interest rate recently hit a 3.5-year high, above 15%. And as for obtaining a new mortgage rates may be low, but getting an insolvent bank to give you one is another story, particularly when you have no credit rating. Which is why, of course, the government has gone hog wild attempting to reverse the horrific multi-year collapse in home ownership with new no-money-down programs financed by their newly nationalized Fannie Mae, Freddie Mac, and FHA subsidiaries, financed initially by Fed money printing and ultimately by the taxpayers, by the inexorable inflation such money printing engenders, and the inevitable bailouts when such suicide loans go bad. Not to mention countless trillions of government-financed or guaranteed, either explicitly or implicitly, student and auto loans guaranteed to eventually default as well. Back to Satan's laundry list, it is truly remarkable how so many horrific events can occur simultaneously, and yet the government's myriad manipulation mechanisms manage to prevent stock prices from ever falling. As in today, when, as usual, the global stock plunge was miraculously reversed the second the U.S. pre-market futures session opened, followed by the daily precious metal smash at the COMEX Open for no other reason than preventing fear of the aforementioned issues from starting a market panic. Clearly, the fact that essentially all the COMEX's registered gold is gone, whilst Chinese plus Indian demand runs at a pace at or above that of total global production, is a reason for gold to plunge to multi-year lows. Not to mention, as essentially every central bank has gone all in with ZERP and QE to infinity policies as their economies and currencies collapse, and let alone the mining industry, which is on the verge of collapsing itself. Or back to currencies, in the true case of true basket cases like Brazil, one of the so-called BRICS powers taking over the world, actually raising interest rates as their economies collapse to prevent the currencies from being completely annihilated. Which, of course, they eventually will, with the Brazilian real being a perfect example, in that, despite this morning's 6th straight central bank interest rate increase, the real sits near its all-time low, having lost 50% of its value in the past year alone, with a lot more pain to come, especially if oil prices continue to plunge. Particularly when the Fed rejoins the global final currency war with a flourish, when Whirlybird Janet inevitably unleashes history's largest inflation exportation scheme in the form of QE4. But more on that in a second, as first I want to return to the ecstasy of the 1% on the receiving end of the Fed's free money and PPT market manipulation mechanisms. Normally, I don't speak much of the financial bubbles engulfing the planet like the Ebola virus, as frankly, 2 decades of investing have taught me to avoid rigged financial markets like the plague. Ultimately, the post-2008 gains will be vaporized, either via hyperinflation or 2008-style crash, and thus I'm content to wait this process out in the time immemorial safety of physical gold and silver, which, no matter how much paper the powers that be conjure, cannot be destroyed. And of course, the more they print, and the more their suppressions destroy a mining industry already on death's door, the more valuable it becomes. That said, it's difficult to watch what's going on around us without paying attention, as not just subjectively, but objectively, today's bubbles have long since put 2007, 1999, 1987, and even 1929 to shame. I mean, I worked as an oil field service and equipment analyst at Solomon Smith Barney in 1999, at the heart of the internet bubble, in which role my bankers forced countless oil field internet startups on my team, forcing us to abandon oil field analysis in lieu of hyping their worthless IPO offerings. Heck, to this day, the most publicity I've ever received was when my team published a report titled Bubba to Bubba, in which, prompted at gunpoint by our bankers, we highlighted the massive upside potential of internet business-to-business startups in the oil field space. Thankfully, we never got a deal done, as ironically the report was published in March 2000, just as the internet bubble started to crash. To a man, I never thought I'd see such a financial mania again, which of course arrived a mere 5 years later, when Alan Greenspan's post-crash monetary easing unleashed a real estate bubble more lethal than even the internet bubble, as not only did it involve citizens' remaining financial resources, but put them in the position to lose their homes. Which of course they did, as this final straw broke not only the financial markets, but the global economy itself. At this point, each new euro, dollar, yen printed negatively impacted the economy and financial markets, which is why the powers that be felt the need to completely commandeer financial markets and the media alike when global financial collapse 2 hit in mid-2011. And of course, to take the world's largest fiat Ponzi scheme into hyperdrive by parabolically accelerating the repressive interest rate policies that have destroyed the 99% reading John Hilsenrath's article. And of course, the QE that has not only deformed economic activity so grossly it could take decades to unwind, but taken financial and other 1% market valuations to unprecedented nosebleed levels. And this amidst the worst economic environment of our lifetimes and the lowest interest rates in centuries, which of course must be maintained or the entire debt-infested global economy will instantaneously implode. To wit, I have written recently of some of the incredible bubble statistics that threaten to collapse of their own weight any day now, such as yesterday's chart of how the number of Chinese retail margin brokerage accounts exploded from 200,000 5 months ago to 4.4 million today, care of the maniacal PBOC monetary easing that clearly seeks to mirror Japan's Abenomics, which, as a matter of Bank of Japan policy, recently started overtly monetizing Japanese stocks as aggressively as it does government bonds. And thus, against a backdrop of Chinese economic activity running at 35-year lows, plunging further into the abyss with each passing day, the Shanghai Stock Exchange has risen nearly 150% in the past 10 months, coinciding perfectly, I might add, with the PBOC's first unexpected rate cut last August. As for Japan, even amidst this month's powerful dollar plunge, the yen has broken multi-year support of 120 to the dollar, collapsing to 124.5 as I write, potentially en route to the 300 plus per dollar levels of the late 1970s, which in today's 250% of GDP Japanese debt environment, as well as the demographic hell I wrote of 3 years ago, would undoubtedly catalyze complete utter social and financial chaos. To wit, here's what I wrote in The Real Yen Bomb Starts Now in May 2013. Just as Abenomics, which has since been expanded amidst an historic implosion of not only the yen, but the Japanese economy at large, was launched. Quote, the yen's 5-month plunge stalled out at the 98 to 99 per dollar level last month, and since then my bearishness for Japan's future has increased exponentially. It has been my belief that once resistance at the very, very key round number of 100 was broken, it could yield a multi-year yen avalanche, yielding dramatic inflation for the poster child of monetary easing, representing a template of what the entire world is about to undergo. Which is probably why I at the same time said that I believe Japan will be the first world civilization to experience hyperinflation. But even better, here's what the head of Bank of Japan, Hirohiko Kuroda, just said as I was editing this text. Quote, I trust that many of you are familiar with the story of Peter Pan, in which it says, the moment you doubt whether you can fly, you cease forever to be able to do it. Enough said. Now here in America, no matter how many seasonal adjustments the BLS, BEA, and other government book cookers add to economic data, the fact remains that the responses to John Hilsenrath reflect what the economy really looks like, which, by the way, is far worse than the negative 0.7% first quarter GDP growth rate purported, which comically included the first negative GDP deflator in 6 decades, at a time when I personally have never been more aware of the exploding cost of living, such as, for instance, the 25% property tax increase the entire Denver metro area just received last month. Not to mention, as average gasoline prices, which the Fed claims to be a significant deflationary factor despite accounting for no more than 3% of average household costs, has jumped by 65% in the past 4 months. Yes, in January I was paying about $1.75 a gallon for gas. Today, $2.70 a gallon. Yes, Whirlybird Janet claimed 6 months ago that falling oil costs were a net positive for the economy, which, as it turns out, validating what I wrote in October's crashing oil prices portend unspeakable horrors, was dead wrong, as U.S. macroeconomic data nearly across the board has plunged to 2008 crisis lows, as have nearly all commodities, despite the oil PPT's pathetically transparent market goosing, despite Yellen's hollow claims, with the CRB commodity index amidst today's across-the-board pre-OPEC carnage down to within just 5% of its March lows, i.e. when said oil PPT blatantly emerged, which I might add are the same lows experienced at the 2008 crisis bottom. And given that the 2008 low coincided with a spike bottom print of $33 per barrel for WTI oil, you can see just how much further the average commodity price has since fallen. You know, the 99% of commodities whose prices are not supported by an OPEC-like cartel. Which, by the way, is the horrific earth-shattering trend I described in January's direst prediction of all, i.e. the massive industrial overcapacity caused by decades of money printing and financial engineering, which could take not years, but decades to unwind. Oh, and by the way, back to that 2008 crisis low in the CRB commodity index, which, by the way, was in February 2009, not in late 2008. Well, guess where gold was back in 2009 at the bottom? It was at $1,000. So basically, while all the other commodities in the world have fallen, the gold price has risen despite all of the massive smashing we've seen in recent years. Okay, and yet, back to the markets, and yet, the S&P 500 PE multiple is well above the 2000 mania highs. Ironically, as CNBC's ratings plumb their all-time lows, given how the public left stocks long ago. So who has taken New York Stock Exchange margin debt to levels 50% above the 2000 peak, you ask? Why, the same handful of one-percenters, i.e. banks and other government minions, that have received the Fed's free money and PPT market support since Ben Bernanke initiated ZIRP 7 years ago, which, by the way, includes the vulture-like activist shareholders that care of hundreds of corporate charters incentivizing nothing but higher stock prices have cajoled corporate America to literally stop investing in their businesses in lieu of mergers, acquisitions, and buybacks. To wit, since the 2008 crisis, global debt, on balance sheet only, that is, has increased by $57 trillion, whilst the global economy has plunged to its weakest level with its weakest outlook in generations. And yet, not only has corporate capex growth plunged close to zero, but buyback announcements have literally exploded to the point that the 2007 record is on pace to be shattered by roughly 50% in 2015, which coincidentally has caused hedge funds to go more long the stock market than at any time in U.S. history. PPT and Yellen put notwithstanding, this is the height of corporate hubris and long-term shareholders' destruction, as we have seen every time throughout history such insanity has occurred. Let alone today, amidst the worst global economic climate in generations and multi-century lows in interest rates that must eventually rise amidst the largest, most rapidly expanding debt edifice in history. To that end, I have spent an inordinate amount of time discussing what could be the most blaring red siren of a bubble top imaginable, i.e. the unconscionable, internet mania-like run in the stocks of staid fast food and chain restaurants, and this whilst the industry's bellwether company, McDonald's, is amidst a multi-year sales freefall so steep it recently fired its CEO and stopped reporting the industry's most widely watched statistic, same-store sales. And this, whilst the Obama administration's shameless pre-election voter push has strong-armed them into raising their minimum wage. Anyhow, I have watched with amazement as Chipotle, which boasts neither good food, service, or ambiance, has become a $600 stock, when back in my Wall Street days, which I might add ended just 10 years ago, only a handful of stocks in the entire equity universe ever reached triple digits. From Popeye's Louisiana Kitchen, El Pollo Loco, Jack in the Box, Red Robin, and even the grilled cheese truck, if you sell crappy unhealthy food, you've been taken public and or to nosebleed valuation levels. And I haven't even gotten into Shake Shack, whose publicity photo of a sloppy, bacon and cheese slathered, completely undistinctive hamburger makes me want to puke, which by simply putting out a filing that it is considering a sister Chicken Shack chain, saw its stock rise by 50% in less than 2 weeks to a valuation of $3.5 billion or $55 million per each of its 63 locations. Well, if you thought that was bad, the so-called icing on the cake of this historic bubble, which has taken the Russell 2000 index of largely unprofitable junk 120% above its 2000 mania peak, when not 20% above its mania peak, 120% above 2000 levels, when none other than the state greasy hamburger chain Wendy's, who admittedly makes an amazing Frosty, announced that yesterday it would be buying back half of its shares. Like McDonald's, Wendy's shares, which are down 65% over the past decade, have been languishing under the weight of not only weak consumer spending, but a lack of growth opportunities, given that it already has more than 6,500 locations. To that end, to give you an idea how ridiculous Shake Shack's valuation is, at last month's high, Shake Shack's valuation market cap nearly surpassed Wendy's, despite having not only a decided lack of ambiance, but a complete and utter lack of product differentiation. And oh yes, 6,000 less locations. But have no fear, as the Fed's zero interest rate policy strikes again, as no doubt bankers like Goldman Sachs and JP Morgan convince Wendy's management, which unquestionably is incentivized principally by stock price appreciation, to not only buy back half the company's shares, but borrow all the money to do it. At rates, of course, which could never rise, right? When all is said and done, Wendy's will have doubled its debt and done absolutely nothing to benefit long-term shareholder value. But what about the short term, you say, which is the only thing corporate America seems to care for, I might add? Well, as I write, barely 24 hours later, the stock has barely budged from the pre-announcement price, which is exactly how a top is defined and exactly what the Fed fears will occur when, not if, it is inevitably forced by collapsing markets to announce QE4. As for Europe, we are literally one day from what could be the default herd around the world, which is probably partly responsible for the global surge in interest rates I'll get to momentarily. And if not tomorrow, as seriously, does anyone really believe the big one will be commenced over a measly 300 million euro interest payment? Then shortly thereafter. As not only are another 1.3 billion euros of payments due later this month, but Greece's 4-month debt extension is less than 3 weeks from expiring. And at this point, it's hard to believe anyone really believes a new bailout is possible. Estimated, by the way, to be as much as 50 billion euros of new, freshly printed euros. From the Germans, to the Greek government, to the exploding Greek anti-austerity movement. And even if such an agreement somehow occurred, to what end? Adding 50 billion of euros to a roughly 400 billion euro debt load that currently can't even support a 300 million euro interest payment in an economy in deep recession with new austerity requirements that won't even be adhered to will only make for an even bigger financial implosion, likely immediately after such bailout is received. And of course, it's not just Greece that's in trouble, but nearly all of Europe, from Spain to Italy, France, Portugal, and countless others, all of whom have well-developed anti-austerity, anti-euro movements of their own, and particularly Spain, which will likely provide the next pig's flashpoint, either via the anti-austerity Podemos' near-guaranteed presidential victory in December, or a renewed Catalonian secession impetus. Not to mention the UK, which by this time a year from now may have already exited the European Political and Trade Union. Which brings me, if not circuitously, to today's principal topic, of the conundrum Janet Yellen faces in having spent the past year plus pretending to be on board with the pretend monetary policy tightening propaganda that commenced with a closed-door meeting between Obama and the top too-big-to-fail bank CEOs in April 2013. You know, a mere day before gold and silver prices were viciously attacked, whilst the ugly lie of tapering made its initial public appearance. As noted above, the U.S. and global economy is unequivocally at its lowest ever point in generations, as I write this very minute. And as I have first discussed in last month's Tectonic Market Shifts Portend Disaster, global interest rates have inexorably risen for the past 6 weeks. And this as the ECB increased the scope of the $1.2 trillion QE program that just commenced in March, whilst the Bank of Japan claimed that even the thought of ending Abenomics was a nightmare scenario. And of course, the PBOC went berserk with its own version of not just QE, in essentially giving countless insolvent municipalities the option to swap their toxic debt for freshly printed Chinese government bonds, but in essence, supporting the stock market as well. Heck, the European rate surge has been so steep in the past week and so broad that most European sovereign bond yields are now trading above the levels when the ECB's QE program was initially announced. And better yet, attesting to just how broken the so-called markets, in which 150 plus fiat toilet papers trade against each other, have become, the euro has actually surged as a result. And this mere days from a potential Greek default. Not to mention, as rates here in the United States of financial debauchery too have been rocketing higher as well. Which, by the way, for those promulgating the age-old, dramatically disproven propaganda of gold's performance being tied to that of the dollar index, or for that matter, that gold prices are freely traded, gold's price has been viciously attacked over the past week, as always, via the same algorithms at the same times of day, despite the dollar index plunging by more than 5%. Yes, the mythical rate increase I have screamed for years is not possible, given not only the aforementioned historic debt load that absolutely cannot be serviced, much less rolled over if today's historically low rates are not maintained to infinity, but because the aforementioned unprecedented financial market valuations, again amidst the worst economic backdrop and outlook of our lifetimes, will literally implode if the ultra-low interest rates and limitless interest-free liquidity that comes with them are not continually fed to the market in increasing quantities by the only entity with the power to print it, which I might add is also the world's largest fixed income hedge fund, holding a $4.5 trillion portfolio of toxic assets at historically high valuations. Which is why Whirlybird Janet is being rapidly pinned into a corner, as now that rates are rising for the wrong reasons, no matter why, the absolute most dangerous thing she could possibly say would be that the rate rise is due to a strengthening economy, which would only catalyze further rate explosions. And if they actually had the cojones to hint at a near-term rate hike from the platform of the upcoming June 17th FOMC meeting, they could literally collapse the markets instantaneously. And adding to her conundrum is the fact that, euro crisis notwithstanding, the dollar has actually been plunging despite the so-called recovery she reports, and rate hikes we have been propagandized to believe are imminent, other than in the alternative universe the Miles Franklin blog inhabits, of course. I mean, even if the BLS is ordered to triple seasonally adjust tomorrow's NFP report to enable the best ever jobs increase, not that anyone would believe it, what if the dollar continues to fall? Heck, what if Greece misses its interest payment tomorrow, triggering a statutory default, and the euro rises? What then, Janet? Could it be that the market, which as it turns out is bigger than the central banks that aim to control it, are well aware that everyone is all in on ZERP and QE to infinity except the Fed, and thus it's only a matter of time before the Yellen reversal I have long predicted hits global financial markets, and particularly dozens of already collapsing currencies like an F5 tornado, which, as noted above, has just as strong a chance of catalyzing the big one as enabling a few more years, months, weeks, of can kicking. Perhaps that's why the dollar is plunging against the euro a day before a potential Greek default. Or perhaps the so-called markets are simply being roiled by the aforementioned tectonic shifts that precede a catastrophic earthquake. Consequently, the time is now, particularly with precious metal prices suppressed well below the cost of production, amidst record global demand and the ominous prospect of peak gold staring us in the face, to protect your assets from what's mathematically certain to be arriving shortly. To that end, for those considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. Moreover, we remind you that not only are my articles and podcasts, as well as David Sheckman's and whoever else we feature, sent out via free email each day, which you can receive by simply entering your email address at our website, but are posted in real time shortly after publication. Moreover, we emphatically invite you to listen to the two special podcasts we recently taped with our president and co-founder, Andy Scheckman, both of which are available, like everything else the Miles Franklin blog produces, for free on our website, or better yet, by simply Googling the title. The first, taped last fall, is titled The Brinks Montreal Storage Program, and the second, taped last month, or 2 months ago now, is titled Swaps, Trades, and Repatriations, discussing myriad opportunities to optimize your precious metals portfolio. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks and have a great weekend.